Bismillahirrahmanirrahim. If you want to learn how Islamic commercial law applies to contemporary finance, then this video is for you. I'm sitting here with my daughter Zaynab. She has no idea what we are going to learn today. And the reason why I have chosen to keep it unscripted is because I think this kind of learning is more engaging, more entertaining, and more retainable also. So Zaynab, do you have any idea what we are going to learn today?
No, but from the title, I know it's about finances.
Okay, good. Okay, so before we dive in, just a quick NIA check. We are learning it not to impress others or to just increase our knowledge database. The reason we are learning is so we can understand how the divine law works, and so we can apply it in both letter and spirit. Okay, so let's get started. This is a quote. Okay, Zaynab, can you read it?
Derivatives are financial weapons of mass destruction.
Okay, who said this?
Warren Buffett.
Yes, Warren Buffett. So what do you understand from it, like generally speaking?
Honestly, I don't know exactly what derivatives are.
Yeah, exactly. You don't know. It's understandable. So derivatives, but what do you understand? Derivatives are good or bad from this quote?
Bad.
Correct. So his point is, and obviously he was one of the most, probably the most successful investor of the last century. And he said that derivatives are bad, extremely bad, even though he was he was considered the Oracle of Omaha, and he knew all about investment strategies. So today, as you can see this one, there are how many kinds of derivative contracts?
4.
Perfect. There are 4 different kinds of derivative contracts, and they can be sorted into 2 main groups. So the first group is
forward commitment.
All right, and the second one?
Contingent claims.
Okay, so in this video, we are just going to learn about this guy, options, okay? Now, options sound like a very easy thing, but it's a slightly, you just have to have the right scenario in mind to put things in perspective. Okay, what do you understand from contingent?
Nothing really.
Okay, so contingent is similar to conditional. Whenever there is, you can say, whenever, contingent means whenever there is an if in the contract.
Okay.
So let's say if I tell you, Zaynab, if you get 3.7 GPA, I'm going to give you a car. So this is a contract, even though it's a unilateral contract, it's just a one-way contract, but there is an if in it.
Okay.
It's conditional on your getting 3.7 GPA. Okay. So contingent claims always have if in the contract. On the other hand, forward commitment is just a commitment. It's a future commitment, right? Now, just a tip for those who are studying fiqh, the word for contingent is mu'allaq in Arabic, and the opposite of mu'allaq is munajjaz. And the word for future contracts are mudaf ila al-mustaqbal. And also the opposite of mudaf is also munajjaz. So for example, if I am telling you, I will sell you my home next month, is this a contingent contract or a forward contract?
That will be a forward contract.
Perfect, because there is no if. I'm telling you I'm going to do it next month. So that's out of the way. Let's dive into options. Okay, let's make a scenario, because there's one thing very common about options. In most of the contracts, we trade goods and or services, right? In options, we don't trade goods or services. Rather, we trade promises. Just remember that. Okay. I'm simplifying it, right? We trade promises. And we trade promises, why? Because there is fear involved.
Okay.
Now let's make a scenario. Imagine that you own a Tesla stock, right? Now let's say you own a Tesla stock, which is worth $250 now. Now you fear that you want to sell it, but you don't want to sell it now. You want to sell it, let's say, after 1 month. So after 1 month, there is a fear that the price will go down. The market will crash and you will lose your money. Because the last couple of months, we have seen Tesla stock going up and down. Yeah. Sometimes it was as low as, let's say, 150, sometimes it will go higher. So you are constantly in fear that you're going to lose your money. Your stock is worth 250 and you fear that if the market crashes down, and then you're going to lose your money. Now you are having this fear constantly. What do you think you can do to fight your fear?
You could just sell it now before things go wrong.
Very good. You can sell it now. Now imagine you don't want to sell it now. Okay, you don't want to sell it now. So you are just tossing and turning, and there is no way, there is another, you can have, now let's see, okay, let me just draw. This is Zaynab. Now this is Jack. Okay, now Jack knows that you fear that your stock might go down and you're going to lose your money. Now Jack comes to you and he says, Zaynab, you know what? I promise you that if, you see there is an if you want to sell your stock, I'm going to always buy it for $250 no matter what. Even if the market crashes, I'm going to always buy it for $250.
Okay.
Okay. Do you think Jack is doing it out of the goodness of his heart?
Probably not.
Yeah, because it's the finance
Yeah.
world. What's in it for him?
I'm not sure.
Good. Usually when people offer something, they demand what? Money.
Money.
So he is making this promise not out of the goodness or because he wants to put you at ease, but because he is taking some money from you. So basically, let's say he says, if you give me $6 now, I'm going to guarantee that if you want to sell your stock anytime within a month, I will buy it from you with this price. Even if the market crashes, even if it goes down to 100, even if it goes down to $2, let's say, I'm going to buy it for $250. Now, because you are so fearful, you'll say, aha, this is a good deal. Because you can sleep easily. You can just give him $6 and then you can rest assured that you're not going to lose a whole lot of money. So this contract, this promise that Jack made to you, this contract, this binding promise is called option. Now, this is an important thing. It's an option for Zaynab, for you, or for him. Okay, let me put it another way. Let me just put it this way. Who is obliged and who is not obliged?
Jack would be obliged.
Very good. So Jack is obliged to what?
To buy your stock.
Very good, to buy. Now, on the other hand, are you obliged to sell?
No.
Very good. So you are not obliged to sell. So this is very important. When somebody is obliged, you are not obliged. It means that it's optional for
me.
Yes, it's optional for you. It's not an option for him. It's optional for you. So we say that you have the option to
sell it to him.
Good. Option to sell. You are not obliged. You just have the option to sell. But he is obliged to buy if you choose to sell. Now, this is one important thing, because it can, when I give the another scenario, it can become very confusing. So we are taking it step by step. Okay. Now imagine this scenario that after 1 month, let's say that what you feared came true, and instead of 250, it came down to the stock went down and it became $100 only. Do you think you will sell him then?
Yeah.
Yeah, of course you will sell him because you don't want to make a loss.
Yeah.
If you sold him, and of course he will have to buy because he made a promise to you. Now, who like you saved some money, right?
Yeah.
How much money did you save?
I saved 244. So 250 except for that $6.
Very good, very good. So you actually saved by buying this option. You saved how much?
244, I think.
244 or you 250 was the stock.
And I paid that.
Yeah, you paid that, and you are selling it for 100, right?
Oh yeah. But then
No, you are not selling it for 100. You are getting 250 out of 250.
Yeah.
But if you had sold it, we are just having this hypothetical scenario. If you didn't have an option and you had sold it for $100, that means that you had incurred, yes, 150, and then you minus 6. So, yes, 144. So actually, you saved yourself $144.
Okay, yeah.
Correct?
Yes.
Now this guy, how much you profited? So it's your profit. Let me just. So you profited, like, or you can say instead of profit, you can say you saved yourself. You spared $144. How much do you think this guy made a loss?
He lost his $250, except for that 6.
Yes. So because he's gonna give you now how much?
250.
But the stock is 100. So.
But his agreement was to buy it for 250.
Yeah. So let's say he promised to buy it for 250. So he is giving you 250. But the stock is actually worth how much? 100. So 250 minus 100 is
150.
150, but he profited $6.
Okay.
So we minus it. So 150 minus 6 is 144. So he lost actually,
What I gained.
yeah, what you gained. So if you gained 144, it means that he lost 144. This kind of scenario where one person's loss is another person's gain. Sorry, one person's loss, this person's loss is this person's gain. What is this situation called in game theory?
I don't know the term.
It's called zero-sum game. Zero-sum game. And zero-sum game is kind of like a gamble. Because whenever you gamble, whatever you lose becomes somebody else's profit.
Yeah.
Okay, so one thing, whatever, this was the second thing, right? Let's make it into boxes. First, we discussed about obligation, that the person who buys the option has the option. But the person who sells the option, like this person was selling the option, he didn't have an option.
Okay, so the one who initiates the deal?
Yeah. So initiating would be confusing. Just say that let me just get some vocabulary straight with this. The person who is buying, who has the option, it's called option holder. So Zaynab is now the option holder because you have the option.
Okay.
And option holder is always the buyer, basically. You are the buyer of option.
Okay.
Okay. On the other hand, this Jack, he is the option giver, option writer. We call him option writer. Or you can say seller of options, option seller, right?
It's just kind of like he's giving the service to
Yes,
you.
exactly.
Okay.
He's giving the service. So buyer of option is always has an option because he is buying the option. So it's optional for him. It's always optional for him to do whatever he wants. But Jack doesn't have any option. He is obliged. So this was actually ties into the point number 1. This is the point 2, that it's a zero-sum game. Now on to the point, okay, we already learned the point 3 about the different vocabulary, right? This is option writer, your option holder. Yeah, another very interesting thing. That's the number 3. This kind of option, which is the option to sell, it's called put option. Okay, so let's just make another quick flow chart. There are 2 kinds of options: call and put. Put is the option to sell. What is the opposite of sell?
Buy.
Good. So option to buy is the call option. So now this scenario was about the put option. Let me twist the same scenario to make it call option.
Okay.
Let's see. Again, you are Zaynab, okay, and this is Jack. Now let's say this time you don't own anything.
Okay.
You don't own anything, but you want to buy a Tesla stock. Okay. Now the price of Tesla stock is $250, but you don't own any stock now. You plan to buy a stock next month,
Okay.
or by the end of this month, but you fear that the price will go
Up.
Very good. You fear that the price will go up. So obviously you need some kind of surety that the price that, let's say you have only $250 in your pocket money. So you don't have more, and you fear that the price will go up. Now again, you are tossing and turning, and this Jack comes to rescue you. What does he promise this time?
That he will sell it to you for $250.
Very good. Now he is giving you the option that he will sell you if, again there is an if you want to buy it, if you want to buy Tesla stock, then he will sell it to you for $250 no matter what happens, even if the market goes up, even if it becomes a $500 stock, but he will sell it to you for $250. And again, by just making this promise, he's not doing it out of the goodness of his heart. He's making money out of it. So he's going to charge you, let's say, again, $6. Now, something that I missed was two more vocabulary words. This price that both of you lock on, it's called a strike price. Okay, strike price. And this price that he charges you for making a promise, it's called premium. It's just like insurance. When you buy insurance, you pay them premium. So he's kind of insuring you that whatever happens, you give me your premium, and if you think you will lose, then I'm gonna make it up for you. So he's selling you, so he's making this promise. So this is called premium. This is called a strike. Now again, who has the option? Who is obliged and who is not obliged?
Jack is obliged, and I have the option.
Very good. Jack is obliged to
sell you.
Very good, to sell. Are you obliged to do anything?
No.
Yes, you are not obliged to do anything. But you do have the option to,
So, buy.
yeah, you have the option to buy. And earlier we learned that option to buy is called,
Call.
yes. So he is selling you a call option.
Okay.
So this is called call option. So you have the call option. Call option, okay. Again, the same thing happens. Imagine that market is very favorable for Tesla and the stock goes up to, let's say, again, 350. Do you think you will exercise your option now?
Yeah.
Yes, because you don't want to lose money. Like you don't want to buy more expensive.
Yeah.
So what will you do? You will go to Jack and you will say, you promised me that you will sell it to me for 250 and then you have to sell it to me for 250 even if the price is actually 350.
Yeah.
So instead of 350, you are buying something for 250 only. So you are making a profit of
$100.
very good, $100. And on the other hand, the actual price in the market is 350, but he is selling you much lower. So he is making a loss of
100.
Yes, he's making a loss of 100. Again, whatever you are losing, he is gaining, and vice versa. And same thing. If, for example, if the market actually, instead of going up, if the stocks come down, what do you think you will do? If the stocks come down to $100, do you think you will go to Jack?
No.
What will you do?
I'll just buy it for $100.
Yes. You won't exercise. You won't have anything to do with option. You'll just say, okay, whatever I paid. I don't worry about it. Of course, you'll buy it directly from the person. You'll buy it for $100.
Yeah.
So either way, you will be in good shape.
Yeah.
So usually it's the option seller who is going to make loss because you have the option.
Yeah.
You are losing only the premium. Only the premium that you lost if you didn't exercise that option, if you didn't take advantage of your option. So you lost only your premium and that's it. But the person who is selling options, he can make a lot of loss.
Yeah.
Because you see here, he's making $100 loss. And in the previous scenario, he was also making $140 loss.
Yeah.
So this is about profit and loss and about premiums, about call options. Is there anything I missed? Okay, now back to the point. The reason why this, first let me ask you, do you think this trading in options should be allowed in Islam? And if yes or no, what do you think?
I think it shouldn't be. Maybe. Because you're profiting off of someone else's loss. Yeah. I'm not really sure. Because like with interest, you're profiting off of someone's loss. But I haven't really heard rules about this stuff specifically.
Okay. So remember what I mentioned about a zero-sum game? That it's very similar. Oh, another key term. Yeah, two key terms. One is hedger. The other is a speculator. Maybe I should switch them. In all cases, if you just look at all the like both scenarios, who is the person who fears something in the future and doesn't want to take the risk?
The buyer?
Yes. So that's you. In both cases, the buyer or you, Zaynab, you didn't want to take the risk. So you were fearing something. In one scenario, you feared that the price will go up. In another scenario, you were fearing that the price will go down. So you were fearing risk.
Yeah.
And instead of taking the risk, you were pushing it onto someone else. Okay, so you didn't want to take the risk. When you avoid risk in any contract, then you are the hedger. You are hedging, right? You are kind of protecting your investment. And in both scenario, the seller of option, the option seller, who was Jack, he was accepting risk.
Oh, yeah.
So you were avoiding risk and he was accepting risk in both scenarios. And the person who accepts risks is called speculator. But he wasn't, because these are just two terms. Like in this contract, we will say that you are hedging and he is speculating. You are hedging because you are protecting yourself. And he is speculating because he is thinking, oh, the market, whatever your fears are illegitimate. So he is accepting risk and you are pushing risk away.
Okay.
The problem with this kind of scenario is that it's very similar to gambling.
Oh, yeah.
You are not trading any goods or services. That's what when I mentioned in the beginning.
Yeah, the zero sum.
Yeah. So it's a zero-sum game. So for example, let's say, let me just juxtapose it with a contract, with a good contract where somebody is selling goods or services. Let's say you go to a hairdresser. Now you go to a hairdresser, so you get this hairdresser, and this is you, Zaynab. When you go to a hairdresser, you pay her, let's say, how much for your haircut?
$50.
$50, okay? And in return, she gives you what?
A haircut.
Yeah, she gives you a haircut. So she's providing a service and you are paying her money.
Yeah.
And so both are creating something. Like even if you are accepting something, but you are kind of giving her something. It's not that your loss is her gain or her gain is your loss, because both parties are gaining.
Gaining something they want.
Exactly. So it's a win-win. It's a win for you, and it's a win for the hairdresser, because she's getting money, and you didn't want money, you want your hair cut. So both parties are gaining. But in this kind of scenario, one person is always losing and the other person is gaining. So to make it very simple, gambling is a win-lose game. Whereas all other contracts, Islam wants all contracts to be a win-win game.
Yeah.
Whenever a game becomes win-lose, like a zero-sum game, then it becomes problematic.
Okay.
And there are different verses like يَسْأَلُونَكَ عَنِ الْخَمْرِ وَالْمَيْسِرِ قُلْ فِيهِمَا إِثْمٌ كَبِيرٌ وَمَنَافِعُ لِلنَّاسِ. So Allah subhanahu wa ta'ala says that maisir is the key word here. Maisir is usually associated with this kind of, it's actually, maisir stands for gambling, but it also stands for all those kinds of contracts where there is significant kind of speculation. Like parties are speculating about some future event or about the nature of prices coming up and down. So nobody is providing any goods or services. People are just sitting in front of the computer speculating and just playing upon each other's fears. Okay, so that's it. Do you have any questions?
Well, I'm just curious. So would that make like buying stocks wrong, because you're not really paying for a service, you're just putting in your money and expecting some back?
Yeah, very good. So options are not stocks, right? Because you are not buying stocks, you are buying the options of stocks. Okay, so that's the difference between stocks and options.
Okay.
But you are right. If you are buying stocks just because you want to sell it so you can make some profit, then you are basically speculating.
Yeah.
You don't want to own the Tesla stock as much as you want to get the money that you get after selling that stock.
Yeah.
Right? But again, not all kinds of speculations are haram or impermissible. This kind of is like, if I am buying a house and I plan to sell it later, I'm speculating because I am hoping that the prices will go up and then I'll sell my house and make some profit out of it.
Oh, yeah.
So there is some kind of a speculation involved in almost all contracts, like in many contracts. You can't avoid that.
Yeah.
But when the speculation becomes the main point or the main commodity in a contract, then it becomes problematic. Because in options, there was no house, there is no stock.
Yeah.
And another good point, the reason why options are called derivatives is because they are deriving their value from the underlying stock. So for example, the Tesla stock, you are just trading promise.
Yeah.
Promise to buy, promise to sell. Option to buy, option to sell. You guys are not trading the stock itself.
Yeah.
But your promise matters. Why does it matter? Because there is an underlying stock. Like the stock is there.
Yeah.
Imagine if there was no stock. Imagine that something happens and there is an earthquake or something and Tesla is gone forever. Then the options wouldn't matter.
Yeah.
Right? Another interesting thing for those who are studying fiqh, when Jack promised to sell in the second scenario, right? When he promised to sell, then you cannot sell anything unless you own it.
Yeah.
Many times the option sellers, they don't own the stock that they promised to sell. They don't have a penny to their name sometimes. Okay, I'm just exaggerating it because the government has some regulations on them, but they are called naked options because they are not covered. So, and the dangers, that's why going back to the quote that Warren Buffett said, that they are financial weapons of mass destruction, is because sometimes there is just one stock, one tiny stock, but there are 100 promises attached to it, 100 options, because there is no one stopping people from making promises.
Yeah.
So what happens, imagine that 100 people promised on one single stock, and then what if all of them have to fulfill their promise, but there will be just one stock.
Oh.
So this is what happens, and that's why the government has regulations. All financial crises, that's how it happens. that the actual real thing is just a tiny bit real thing. But there are so many things attached to it. And then people just making, promises, I'm going to buy, even though they don't have it to their name. And that's how we have bank runs, because the banks give too much money out and they don't have enough money. And because banks think, not all people are going to come at once. So they start giving too much money. And when people wake up, and sometimes they do come all at once, and then there's not enough money. So options that's why they're dangerous. And this is just one aspect of it. So there are two kinds of options, call and put. Option to buy is called call option. Option to sell is called put option. So here's the verse. يسألونك عن الخمر والميسر قل فيهما إثم كبير ومنافع للناس وإثمهما أكبر من نفعهما. The interesting thing is that we are not claiming that wine and gambling and all other financial instruments that are gambling-like, they have no benefits. Of course, they may offer some benefits, but we say that their sin outweighs their benefit. Also, one problematic thing about options is that, as I mentioned, they are mu'allaq contracts. They are contingent contracts. And one prerequisite of a valid sale contract is that it has to be munajjaz. It has to be right then and there. It shouldn't be a forward commitment, and it shouldn't be a contingent contract. And this is something that all the fuqaha unanimously agree upon. And if you really want to dig deeper into it, you can look at Fiqh al-Buyu, volume 1, page 477. And here in the references, he also gives this Mawsu'a Fiqhiyya Kuwaitiyya reference. If you go there, you're going to find all the primary references where ulama have debated this prerequisite. All right. Thank you, Zaynab, and thank you. Jazakumullahu khairan.